All right, let's take a look at this chapter here. This chapter is about the free cash flow valuation model. Okay, let me give you an introduction. This is a very broad introduction here. Previously, you have seen the dividend discount model, right? In the dividend discount model, the cash flow is the dividends, right? Now, in this chapter, however, we're going to extend this model to include the free cash flow to the firm, or FCFF, and the free cash flow to equity, FCFE. Right, so it's the same framework as the dividend discount model, but this time instead of looking at dividends, we're looking at free cash flow. And there are two types of free cash flow. You have free cash flow to the firm and free cash flow to equity. Well, let's take a look at the difference between dividends and free cash flows. Dividends are the cash flows actually paid to stockholders. Right. On the other hand, free cash flows are the cash flows available for distribution. Right. So just because a company has some cash available doesn't mean it is being distributed, but it's available for distribution. Whether or not it's distributed, that's another story. Okay. So this is the available cash flows. Okay, so if you apply the same framework, in the previous chapter, you've seen the discounted cash flow model, and we use dividends as our cash flows, right? In this chapter, we're going to extend this framework to include the free cash flow to the firm, FCFF, and the free cash flow to equity, or FCFE. Now, the question is, under what circumstances would it be advantageous or beneficial to apply the free cash flow valuation model? Well, the answer is if you run into one of these situations, then you should apply the free cash flow valuation model. Number one, if the firm is not paying dividends, right? Obviously, if the firm is not a dividend payer, then you cannot apply the dividend discount model. Right. Second, the firm is dividend paying, but dividends differ significantly from the firm's capacity to pay dividends. In other words, the dividend pattern is not consistent with the underlying profitability of the firm. Right. So if the firm is profitable but it doesn't pay any more dividends, then you can say, well, the dividend policy of this company doesn't reflect its profitability. Then you should not use the dividend discount model, and you could be using the free cash flow valuation model. Third, free cash flows align with profitability within a reasonable forecast period with which the analyst is comfortable. Okay, so if you think that if there's any reason for you to think that free cash flows are consistent with profitability, then you should be applying this model. Okay, and finally, if the investor takes a control perspective. Okay, this is the opposite to the dividend discount model, because when you apply the dividend discount model, you take a non-control perspective. Right, because when you get a dividend, that's not your decision. You don't have any control over the decision to pay dividends or not. On the other hand, if you apply this model, the free cash flow model, you take a control perspective. Okay. Okay. Now the purpose is to value common equity. Right. There are two possibilities. First of all, you can directly use the free cash flow to equity to value common equity, right? Second, you could indirectly use the free cash flow to the firm to value the entire firm. And once you get the value of the entire firm, you subtract the value of non-common stock capital, right? Non-common stock capital such as debt and preferred stock, and you end up with the value of equity. Okay, so you could do it directly by using the FCFE, or you could do it indirectly by using the FCFF. All right, so the question is, how do you define free cash flow, right? Here's a definition. Free cash flow to the firm, or FCFF, is the cash flow available to the firm's suppliers of capital after all operating expenses have been paid and necessary investments in working capital and fixed capital have been made. Okay, it may sound a little confusing right now, but I'm going to show you the equation, and when you see the equation, it's going to be much more clear. Okay, now you have to keep in mind that there are multiple suppliers of capital. Normally you have common stockholders, bondholders, and sometimes preferred stockholders. Most companies don't have preferred stock, and those that have preferred stock, they don't have a lot of capital from preferred stock. So most of the time you have stockholders and bondholders primarily. Okay, on the other hand, you could be looking at the free cash flow to equity. Right. Previously, you have seen the free cash flow to the firm. This time, you see the free cash flow to equity, FCFE, which is the cash flow available to the firm's common equity holders after all operating expenses, interest, and principal payments have been paid, and necessary investments in working and fixed capital have been made. Okay. Okay, now let's take a look at the valuation equation here. Basically, when you get the free cash flow to the firm, what you have to do is you have to discount each free cash flow to the firm back to present, and once you get the present value, that's the firm value. Okay, so in each period, you have free cash flow to the firm, right? And you discount each free cash flow, and you get the present value. Now the question is, what should be the discount rate? The discount rate is what we call the weighted average cost of capital. Okay, so basically you look at the cost of capital, the average, the weighted average. Okay, I'm going to show you an equation a little later, so it will become a little more understandable. Now, when you apply the free cash flow to the firm and you do the discounting, you get the firm value. Okay, this is the value for the entire firm, right? But the purpose here is to get the equity value or stock value. So what you have to do is you have to subtract the market value of that, right, from the value of the entire firm, and you get the equity value. Okay, once you get the equity value, you have to divide the equity value, divide the total value by the total value of equity by the number of shares outstanding, right? And you get the stock price, per share. Okay, now you have to understand how to compute the WACC, or the weighted average cost of capital. Okay, this is the required rate of return that investors should demand. The cost of capital is often considered the opportunity cost of the suppliers of capital. Okay, now let's take a look at the equation for the weighted average cost of capital. We're going to assume that there are two suppliers of capital. You have the stockholders and the creditors or bondholders, right? So this is what you do. The weighted average cost of capital is equal to, you have these two terms. The first term is for debt, right? Market value of debt divided by the market value of total capital, which is debt plus equity. So basically, this is the weight of debt in your capital structure. For example, if 40% of your capital comes from debt, then this part would be 0.4, right? And then you have RD, which is the cost of debt, right? This is the cost of debt. And you have to take into account the fact that the interest expense is tax deductible, so you have to multiply the cost of debt by 1 minus the tax rate, right, to account for the fact that the interest expense is tax deductible. Okay, so the first term is for debt. Okay, the second term is for equity. You have the cost of equity right here, right, and you have to multiply this by the weight of equity in your capital structure. So if the weight of equity in your capital structure is 70%, this part would be 0.7. Okay. The market value of debt and the market value of equity are the current market values of debt and equity, not their book or accounting values, and the weights have to sum to 1.0. In this example, we assume that there's no preferred stock, but if you have preferred stock, then it would be a simple addition. You can just add another term for preferred stock. Okay, up to this point, we have been looking at the free cash flow to the firm, right? This time, we're going to look directly at the free cash flow to equity. Okay, now the free cash flow to equity is, well, what you can do is you can identify the free cash flow to equity in each period, right? And you discount the free cash flow to equity in each period to present, and you add everything up, and you get the equity value. Now you have to keep in mind that when you do the discounting, this time you don't need the weighted average cost of capital, but you need the cost of equity, right? Because you're looking at equity only. So the discount rate here has to be the required rate of return on equity, or the cost of equity. Okay, so once you get the equity value, you have to divide the total value of equity by the number of shares outstanding, and you get the value per share, or the stock price. Okay. Okay, let me start with something very simple. This is the single stage constant growth free cash flow to the firm valuation model. Okay, you can see it's the same framework that we applied to the dividend discount model, but this time the cash flow in the model is not dividends. This time it's the free cash flow. So you assume constant growth, and you assume that the growth will be constant forever. This is why we have this single stage valuation model. Okay. So this equation is telling you that the free cash flow at time t is equal to the free cash flow at time t minus 1 times 1 plus g, right? And you have only one g because g is constant. So you assume that the value of the firm is growing at a constant rate, then firm value is equal to free cash flow to the firm in period 1 divided by the difference between the weighted average cost of capital and the growth rate, right? Once you get the firm value, you have to subtract the market value of debt from the firm value, and you get the value of equity. Okay, this is a very simple framework because it's a constant growth single stage. On the other hand, you, instead of looking at the entire firm, you can look at the free cash flow to equity directly, right? It's the same framework, the same equation, except this time instead of using the weighted average cost of capital, you'll be using the cost of equity here, right? The discount rate here is the required return on equity. And once you do the discounting, you get the equity value directly. You don't have to subtract anything because it's already equity. Okay, now I guess the most important question here is how to compute the free cash flow to the firm, right? And you're going to see multiple methods. You're going to see many methods. The first method is you start with net income. Okay, you begin with net income and you add something, and you subtract something from net income, and you come up with the free cash flow to the firm, right? So here's a definition of the free cash flow to the firm. It's the cash flow available to the firm's suppliers of capital, right? All suppliers of capital, both the debt holders and the equity holders, after all operating expenses, including taxes, have been paid and operating investments have been made. Okay. The firm's suppliers of capital include creditors and bondholders and common stockholders, okay, and occasionally preferred stockholders. Okay, this is a pretty long statement. So to summarize, you can look at this equation here. You begin with net income, right? And then you add the non-cash charges, and usually you have depreciation and amortization here, plus the interest expense multiplied by 1 minus the tax rate, and then you subtract the investment in fixed capital and investment in working capital, and you put everything together and you get the free cash flow to the firm. So this is how you express this equation right here. Free cash flow to the firm, you begin with net income, and you have non-cash charges, plus the interest expense times 1 minus the tax rate, minus the investment in fixed capital and investment in working capital. On the other hand, if you don't want to start from net income, what you can do is you can look at the statement of cash flows, right? In the statement of cash flows, you're going to see the cash flow from operations, or CFO, right? And if you start from the cash flow from operations, then what you have to do is you have to add interest expense times 1 minus the tax rate, and then you have to subtract the investment in fixed capital. Okay, so this time you begin with the cash flow from operations, right? Previously you began with net income. Okay, so either way you should get the same number. Okay, and here's the equation. If you begin from the cash flow from operations, or CFO, you have to add the interest expense times 1 minus the tax rate, and you subtract the investment in fixed capital. All right, so the question is, how do you account for these non-cash charges, right? The most common non-cash charges are depreciation and amortization, right? And you have some other things here. Most of the time you have depreciation and amortization, and these other things, sometimes you may have them, sometimes you may not have them, but depreciation and amortization are by far the most common non-cash charges, and they tend to be pretty substantial. So you should account for depreciation and amortization. Okay, so far we've been talking about the free cash flow to equity and free cash flow to the firm, right? Now, what you can do is you can compute the free cash flow to equity from the free cash flow to the firm, right? So if you have the free cash flow to the firm, what you can do is you can subtract the interest expense multiplied by 1 minus the tax rate plus net borrowing, and you get the free cash flow to equity. Okay, here's the equation here. Alternatively, you could compute the free cash flow to the firm from the EBIT, right? Earnings before interest and taxes. Okay, let's take a look at this equation here. So you begin with EBIT, then you can get the free cash flow to the firm by following this equation here, right? EBIT multiplied by 1 minus the tax rate plus depreciation minus the investment in the in fixed capital and investment in working capital. Alternatively, you could begin with EBITDA, right? Earnings before interest, taxes, depreciation, and amortization, right? And you can compute the free cash flow to the firm by beginning with EBITDA. And here's the equation, okay? So you can see there are so many ways to come up with the free cash flow to the firm, but you don't have to know all of them. Just try to see which method is the best for you, which method you feel most comfortable with, and you can use one of them or maybe two of them, but you don't have to memorize everything because there are so many ways to compute the free cash flow. Okay, the question is, how do you forecast the free cash flows, right? Obviously, because there are so many ways in which you can compute the free cash flow, so there are many ways to forecast the free cash flow, right? One approach is to compute historical free cash flow and apply some constant growth rate, okay? Now, this approach would be appropriate if the free cash flow for the firm is likely to grow at a constant rate, right? And if the historical relationships between free cash flow and fundamental factors are expected to be maintained, right? So basically you come up with a historical free cash flow and you apply a particular growth rate and you assume it's going to continue that way. Alternatively, what you can do is you recognize that capital expenditures have two components, right? You have some expenditures that are necessary to maintain existing capacity, right? And there are some incremental expenditures for growth, right? So what you can do is you can kind of forecast these two components separately. Okay, some companies have preferred stock. So if you have, if your company does have preferred stock, then you just add one more term to the equation. Most companies don't have preferred stock, so this is why we haven't been talking about preferred stock. But if you have preferred stock, it's pretty straightforward to include the cost of preferred stock into the equation. Okay, now we're going to take a look at the two-stage free cash flow models here. Now you have to understand that the free cash flow models are much more complex than the dividend discount models because instead of having only dividends, now you have to estimate so many items like sales, profitability, investments, financing costs, and a lot of other things, right? So it is much more complex. Now, when you look at these two-stage free cash flow models, the growth rate in the second stage is a long-run sustainable growth rate, right? If you have a declining industry, the second stage growth rate could be slightly below the GDP growth rate. Okay. On the other hand, if you have an industry that continues to grow into the future, then the second stage growth rate could be slightly greater than the GDP growth rate. The two most popular versions of the two-stage free cash flow to the firm and free cash flow to equity models are, first of all, you assume that the growth rate is constant or given in stage 1, and then it drops to the long-run sustainable rate in stage 2, right? Second, you assume that the growth rates are declining in stage 1, reaching the sustainable rate at the beginning of stage 2. This second model is like the edge model for dividend valuation. Now the growth rates can be applied to different variables, right? It could be you could apply these growth rates to income or to sales, or to different other items there. So you can see it's much more complex than the dividend discount model because you have so many variables there. So this is a general expression for the two-stage free cash flow to the firm valuation model, right? Here's the you discount the free cash flow to the firm every year up to the terminal year, right? And you have this part right here. The second part is when you discount the terminal value, right? You have the terminal value here. This is how you discount the terminal value. Well, this is how you compute the terminal value, and then you discount the terminal value here, right? You assume that the terminal year is year end, right? So this is just like the dividend discount model, but this time instead of having dividends, you have the free cash flow to the firm. Okay, this is a similar concept, but instead of having free cash flow to the firm, this time you have the free cash flow to equity, right? And the discount rate is not the weighted average cost of capital, but it's the required rate of return for equity, the cost of equity, right? So it's the same framework. You assume the terminal year is year end, right? And then you compute the terminal value here, you discount the terminal value, you add everything up, and you get the value of equity.